Tech rallies. That was the theme for the month of June as the S&P 500 and Nasdaq Composite closed out at new highs. Is the rally for real, or will wages and the jobs reports over the next few months challenge the temporary inflation and a dovish Fed, leading to an increased chance of a correction in equities? Well, that action starts now. Stocks were mixed for the month of June, with the Dow Jones Industrial closing down 0.24%, while the S&P 500 was up 1.92%. The Nasdaq stole the show, though, by posting an impressive gain of 4.88%. This was a nice rebound for the composite after posting a loss of just over 2% the previous month. Early signs indicate the sell in May and go away theory may not be in favor this year. With stocks being a bit range bound for the last couple of months, it looks like we could be working our way into higher highs through the traditionally slower summer months. If the jobs report on July 2nd hits a just right number of 300,000 to a million, investors should expect to see this rally in equities continue. If the number is greater than a million, expect a potentially sharp rise in the 10-year and a sharp sell-off in stocks. A report of less than 300,000 would probably provide us a short-lived small decline in equities. Equity investors were calmed by the nice pullback of just over 11% in the 10-year Treasury, closing out the month at 1.44%. This was caused by a pullback in global bond yields as investors look to take a mild flight to safety as concerns rise over the spread of the Delta variant in Europe. The fear is not so much in the case count, rather the government's response that could bring a pause or reverse of the economic reopening in Europe. The commodity space was mixed in June. As I suggested in last month's report, oil was able to build on its rally from May, breaking out above $70, posting a 9.11% return and closing out at $73.52. If OPEC announces plans to raise output by more than 500,000 barrels a day during their upcoming meeting, investors will see a pause in the energy rally. However, it should not be a bearish game changer. Copper continued its sell-off from May during the first half of June before finding some support later in the month just above the $4 level, closing out at $4.29.5. Copper will be a key indicator to watch in the second half of the year, as prices should respond negatively to concerns about the Fed choking off growth, and likely before we would ever see a big response from stocks. Gold fell 7.5% to $1768.80 in June, giving back all of its gains for May. If the July 2nd jobs report comes in too hot, gold will continue its downward slide. Thanks to quarter-end demand, a safe haven interest from increasing spread of the new COVID Delta variant around the world, and mostly better than expected U.S. economic data, the U.S. dollar experienced a nice rebound from the June sell-off to close at a 2.5-month high at 92.36. Now, I don't expect to see this turn into a strong rally for the greenback in the near future, so long as the Fed remains the most dovish of the major central banks. The May ADP jobs report and the weekly jobless claims early in the month were both stronger than expected. This implies that more people returned to work in May, reducing fears of a structural labor market problem that would keep the Fed ultra dovish and increase inflation. The high-stakes summit between President Biden and Vladimir Putin took place earlier in the month. While both men called the meeting positive, it doesn't appear all that much was accomplished other than an agreement to consultants on cybersecurity, a potential promise on a prisoner swap for 2 jailed U.S. Marines, and a let's see what happens approach from Biden going forward. The reality is, Biden didn't return home with much for deliverables. Looking ahead for the month of July, a just right jobs number could produce the perfect environment for the current rally to continue grinding higher. Let me be clear here. I am not outright bullish. As one trader put it, I am bullishly negative on the market. As I stated last month, a lot of things must go perfect for the bullish trend to continue. However, at some point, the Fed is going to serve up a solid dose of reality to the markets and the economy by reducing their QE substantially and raising interest rates. This will have a bearish impact on the equity markets. However, until then, you cannot afford to just sit on the sidelines and miss out on whatever rally is left for you to capitalize on. At this point, the next major catalyst that I am focused on, which could move the markets, is the Jackson Hole Economic Symposium coming up in late August. If we are going to hear any official announcement from the Fed about tapering, this is the most probable moment for now. As I stated earlier, copper will be a good leading indicator to keep an eye on for any action on this front. For the month of July, our models continue to hold a 30% allocation. Our broad focus remains on domestic equities and commodities. For domestic equities, our attention is on small cap growth, small cap value, small cap blend, and mid cap growth, with an emphasis on the cyclical, consumer cyclical, energy, basic materials, industrial, and financial sectors. As for commodities, our focus remains on energy and industrial metals. As a reminder, my current allocation is not a recommendation. Regardless of what happens next, investors like you need to have a simple and yet solid financial plan that reduces risk, costs, and taxes while securing the necessary income you need to maintain your lifestyle throughout retirement. So if you don't have a plan or you're not comfortable with the plan you have, call me today to get pointed in the right direction. I'm Chad Kuntz, and that puts a wrap on the July 2021 Market Action Report. Thanks for joining me. It's time for me to get back to the markets, and that action starts now.